If you thought that monetary destruction was enormous in the past decade, wait for what is coming ahead. We are likely to see the most aggressive monetary destruction process in decades. Number one, inflation is persistent. You may have heard all over the place that the burst of inflation came due to the so-called supply chain disruptions and commodity prices. However, if that were the case, as this graph courtesy of JP Morgan shows, today we would not have persistent inflation and services inflation of 5% or shelter inflation of 5% and certainly accumulated inflation of 20%. We would have disinflation. That is what it shows, because inflation is always a monetary phenomenon. And the reason why we have persistent inflation is because central banks injected an enormous amount of money that was used by governments to bloat government spending. The trick is the following. Number one, through the easing process, government increases the size in the economy dramatically. Then, if inflation rises, they hike rates and they so-called normalized policy, and what happens is that government continues to increase its size in the economy via taxes and via indebtedness and deficit spending, while the entire burden of normalization falls on the shoulders of families and businesses. Let's go to the next graph, which shows us why people are feeling impoverishment. This is consumer confidence in the United States. Come on, it's way below 2019 levels, way below 2021 levels, and what we hear is that it is rising. It is back. Look at where it's back. It's back to a completely disastrous level. That means that people are feeling the pinch of inflation. People are poorer. Americans are not only suffering from real wage decline in wages in real terms, but also they have to take even more credit card debt, record levels of credit card debt. And inflation is persistent. They tell you that inflation is declining. Absolutely it is. But services inflation, shelter inflation, healthcare inflation, average goods and services, grocery inflation, all of those remain very elevated, actually significantly higher than where they should be. Let's go to the next graph, which shows us what has happened in terms of monetary destruction. Global money supply reaches a new record level and has increased by $20.6 trillion since 2020. A lot of people say that, hey, the worst thing came in 2020 because of the COVID era. Not true. The worst thing came when governments continued to spend like there was no tomorrow, and governments continued to increase their fiscal imbalances in an already recovering economy from 2021 to 2024. The dramatic increase in deficit spending in a period in which the economy was growing and in which tax revenues were also reaching new records. That is the problem that is slowly creating a problem in fiscal terms that will be a problem in monetary terms. This is massive money printing through the back door. Let's go to the next graph, which also shows us how the problem of rates is quite significant. Let's talk about what the market expects. Okay, markets, according to Bloomberg, expect a significant number of rate cuts from the Federal Reserve. However, we need to understand that these rate cuts are coming when inflation remains persistent. So why are they doing it? They're basically cutting rates to make it easier for governments to increase debt. And this is a very significant problem once we have seen that those governments ignored the period of high inflation and continued to spend like there's no tomorrow, therefore perpetuating inflation. That is basically what inflation is, the loss of purchasing power of the currency. And governments create inflation, they increase the size of government in the period of easing, and when normalization happens, the entire burden of normalization of policy falls on the shoulders of families and businesses, and the size of government rises again through taxes. What an incredible way of nationalizing the economy. Let's go to the next graph, which shows us what has happened with the central bank balance sheets. A lot of people talk about very restrictive monetary policy. What the hell? Look at the increase in the balance sheet of the major central banks and what has happened in the period of so-called normalization. A very timid reduction in the balance sheet after the monster increase of 2008, 2011, 2020, and subsequent increases. This is just the beginning. Let's go to the next graph, which also shows us how to protect ourselves. A lot of people look at central bank balance sheets and interest rates. However, what matters is net liquidity for you as an investor. Net liquidity is actually rising and has been rising for a while. This, according to this phenomenal graph, is the correlation between the net Fed liquidity and Bitcoin. Bitcoin, being the most volatile and most exposed to monetary destruction of assets, of risky assets, is showing us that it's very correlated to net Fed liquidity injections. And net Fed liquidity injections are likely to rise. Let's go to the next graph. In this graph, what we can see is the correlation between the S&P 500 and net Fed liquidity injections, also very high. So what you need to pay attention to is that you need to be invested in order to reduce the impact of real inflation, which is the destruction of the purchasing power of the currency. We are going to see a much larger level of monetary destruction, which is what is liquidity injections in itself in the future. Let's go to the next graph, which shows us the fallacy of normalization. This is an enormous increase in net liquidity injections from the central banks. And what is liquidity injection? Printing money. Liquidity injection, printing money. Then a very small decline in that period. What is coming is even worse. Why? Let's go to the next graph and talk about it. In this graph, what you can see is why there will be a much higher level of monetary destruction in the future. Enormous level of public debt. Governments have completely ignored the period of high inflation and have increased their fiscal imbalances, deficit spending through the roof in record growth and tax revenues periods, in periods of economic growth and record tax revenues, Furthermore, what you see is a small decline in debt to GDP. However, that is a trick, because debt rises, GDP is nominal, therefore the denominator is being bloated by higher inflation. So you're being impoverished in two ways. Higher debt, which means higher taxes, less growth, less real wages, and impoverishment in the future, and at the same time, the hidden tax of inflation on the denominator side. This enormous fiscal irresponsibility of the past years is going to lead to an enormous monetary irresponsibility in the future. And you need to protect yourself, investing, thinking of the long term, understanding volatility, understanding the periods of net liquidity injections and contractions, and preserving the value of your savings by being invested and protecting yourself against inflation, which is the destruction of the purchasing power of the currency. And the destruction of the purchasing power of fiat currencies that is coming is going to be unprecedented. Keep defending freedom. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.